This is Brant from Wolf on Wall Street Trade with the market update for the week ending November 13th, Friday the 13th, 2020. I've got a 30-minute chart of the S&P 500 here, and it's backed up to the end of last week. I just wanted to point something out real quick. This is what I call a channel buster. This actually started off as a bull flag. It looked pretty darn good for another leg up, and the longer this goes on and the more it retraces, the less bullish it is. And this is a concept I call a channel buster. So when you have this defined channel and then price drops out of it, a lot of times it's like a momentum slingshot. And when it drops below it over here on a channel like this, I often expect a move to go right back above the top of the channel. So just momentum down, momentum back up, big thing. This 3230.78 level, by the way, from which it bounced, is the S&P 500's year-to-date unchanged mark. So this has been a technical level, as you can see, that has come into play quite a few times. So at the end of this week, this is prior to last week, the week that we're going to cover, it looked like the market was set to come down, and the reason is USD JPY, the dollar Japanese yen, was leading the market lower. So what I have here is a chart of S&P futures in the candlesticks. And by the way, this red trend line is this big broadening top that's been in place since January of 2018. And then in purple, I have the dollar-yen pair, USD JPY. You can see how negative divergence has led the market lower, of course, from resistance at that broadening top trend line. Over here, you can see USD JPY leading the S&P higher. And then over here, you can see a negative divergence leading it lower. So this is how the week prior ended, with USD JPY really leading lower. Now, the dollar is really the key asset that has a really high inverse correlation with the S&P or with stocks right now. But USD JPY, it's a carry trade, carry pair, and it is really good at giving you a heads up of like what risk sentiment is going to be. So when you see it diverging like this, basically it's like a flight to safety. Sometimes it will play out in hours. Most often it's a couple days to a week or so, as you can see over here. But this is the setup coming into this week. It did not look good. We had resistance coming up at this broadening trend line, and USD JPY was leading lower. Then came Sunday night. Now what you're looking at is a 7-minute chart of Russell 2000 futures. So you can see over here is where the previous week that I was just showing you ended. Here's Sunday night. So what happened over the weekend was the news media declared en masse that Joe Biden was the winner of the election. And NASDAQ was actually the one that started rallying Sunday night. Small caps, they were up a little bit. They weren't doing too great. But before the open, I think it was 6:45, something like that, Monday morning before the cash opened, Pfizer came out and they said they have a vaccine for COVID that's like 90% effective. And small caps absolutely soared. They went up 7%. They locked limit up over here and couldn't trade again until the cash market opened. But what's really interesting, and this is going to be a theme of this video, is what it did to NASDAQ. Remember, NASDAQ was kind of leading the rally Sunday night. But watch this area over here. You see what happened to small caps? They soar. Let's take a look at NASDAQ 100 futures. So here, again, is Sunday night. You can see what I was talking about. NASDAQ was leading. Here's when that vaccine news came out. Look at what happened to the NASDAQ. It got crushed. So small caps flew. They went limit up, and NASDAQ dropped. It was in the red badly. And that's a theme we've seen all week, is instead of the market averages all moving together and one maybe has better relative performance than the other, it's like either small caps are up and NASDAQ is down, or vice versa. It's like all or nothing. And here I've pulled up S&P futures, again, 7-minute chart. Here's Sunday. So you can see they also soared on that vaccine news. But look what happens. They give back the entire vaccine news gain by over here. They retrace it all. And then they spend the rest of the week, or most of the rest of the week, in a bearish consolidation, because the preceding move is very impulsive, sharp down. This is like a little bear flag, kind of dips below and back tests it Friday. My opinion as to what caused this was, I was saying vaccine news is good news, but at some point the market is going to get thinking about What does this mean for stimulus? So this is a tweet, and if you're not following me on Twitter, check me out on Twitter. I have the link in the video description. This is a tweet from 9:26 a.m. Monday morning. This is before the cash market even opened. So index futures are up big on the Pfizer vaccine news this AM, except NASDAQ as the reflation trade roars back. Soon, the market will ask, what does this mean for fiscal stimulus? What about Fed accommodation? And that's exactly what we saw when the S&P just wiped out, retraced all of those early vaccine gains. Again, you can see it here, big move up, and then retraces all of them. So I think that's what the market's thinking about. You know, the market has gone up all this year because of trillions of dollars of fiscal and monetary stimulus. So this Russell 2000 small caps outperforming and NASDAQ underperforming, or vice versa, was pretty much a theme on the whole week. So it was basically small caps, which have a lot of cyclical sectors or cyclical stocks, value, the reopening trades, stuff like that. And then versus NASDAQ, which has the mega caps, which are secular growth. They're a little bit more defensive, actually. Momentum also. If we take a quick look at the momentum style factor, here you can see it got crushed. This is the biggest one-day loss for momentum ever. And the last time we saw a big crush in momentum was June. So the second week of May to June, there was a reflation rotation to all these cyclical sectors. It didn't work out, and everybody went back to the FANGs, to the mega caps. So this is the same thing happening. Biggest one-day decline there, but not as sharp as what we saw in June as far as, is this value trade going to hold? The value style factor, on the other hand, had its biggest outperformance over growth in 25 years. So a lot of hedge funds, a lot of professional money moving around on this vaccine news. And we can see this in the weekly stats. So I'm going to pull up some charts of the averages. This is a weekly chart of the S&P 500. You can see it was up almost 2.2% on the week. This is that big broadening top from early January of 2018. And if we kind of zoom in a little bit closer, what you'll see is a lot of these averages had this kind of triangle right below this broadening top upper trend line. And then here is this week. So a little doji star right under that massive broadening top trend line. So a doji star basically means that the market opened and closed. It opened the week here, it closed the week there. So did not do anything to add to it after that opening gain. Now this, of course, is also a candle that signifies a loss of momentum. So we had a big week up before that. So this signifies a loss of momentum, or it can be consolidation. But up almost 2.2% on the week. Remember what I said about S&P futures. You can see the big move up, the retrace of all that, and then spent the week kind of in this bearish flag, kind of a bearish consolidation, dip below it, and then back tested into it on options expiration Friday. Here is the Dow weekly chart. Again, you can see that big broadening formation. And again, if we zoom in close, you can see a little doji star candle. But the Dow did better than the S&P, up 4.1% on the week. You've got cyclicals in there. You've got industrials. So here we are zoomed in. That's the weekly candle, doji star, right? And that is the broadening top. So both S&P and Dow closed below that broadening top upper trend line. Now here's small caps, and here's where it gets more interesting. Again, a weekly chart. This is this trend line I've been talking about, the primary trend from the 2009 low, basically the whole bull market, right? And then here's the break on COVID in March, the crash. So if we zoom in a little bit closer, major outperformance for small caps, up 6%, a little better than 6%. Finally made a new record closing high, closed just a little bit above this level back here, August or so of 2018. So finally did it. The weekly candle looks a little bit like a hanging man. It's not perfect, but could be a hanging man. Here on a daily chart, you can see exactly where this rally came from. This is that trend line I was just showing you that small caps have been fighting with pretty much the last 6 months or so. So rallied off that trend line. Jumping back to the S&P for just a minute, here's this kind of triangle that's been going on since like September. You can see it right here. This is that broadening top trend line. So pay attention to this triangle. We're going to jump to NASDAQ next, and here is where you'll see the really big difference. Small caps up 6% on the week, and the Dow is up, and the S&P is up. The NASDAQ is down. It's not down a lot, 1.3%, but that's a huge disparity between small caps, which are up 6%. And again, notice this triangle, zoom in a little closer. And this is a daily chart, by the way. So here's the big open Monday, boom, just fell right back through it. And then you can see this is acting as resistance again, right around about 12,000. There's another area around 11,900. So again, small caps up 6%, NASDAQ down 1.3%. If one moves, it's at the other's cost. So that makes directional trades very difficult. Usually I'm a directional trader. I don't trade a lot of stocks. I trade the averages or sectors. And if I feel like I want to be long the market, then I'm going to go long one of the averages. And I might see better relative performance or a better entry or better risk reward setup in, say, NASDAQ over the S&P or maybe small caps. And if I can't decide between NASDAQ and small caps, then I kind of split the difference and go with S&P because it has exposure basically to the cyclicals and to the mega caps that are in small caps in NASDAQ. But the point being, it makes it very difficult for these directional trades because on a day that most of the market is up and small caps are leading, the NASDAQ's going to be down. And on a day when the NASDAQ is up, the small caps are going to be down. That is something that is not very usual. We've been seeing it since, I want to say about August, but it has gotten worse and worse and worse as we've gone on. And this week is just the worst I've ever seen it. I'm not going to spend too much time on S&P sectors. You know, there's 11 of them. But the gist is that the cyclical sectors that are growth sensitive, economically sensitive, and value factors outperform big time. So that meant energy, financials, banks, industrials all outperformed. Energy, which was up like 17%. So here's the energy sector, up 17.1%. You can see it's been just horrible, horrible, horrible since, this last value rotation over here, the second week of May into the first or so week of June. Been horrible. This is this week. So broke above the 50-day moving average and it kind of got hung up here at the 100-day. And we have the 200 that is trending down. So that's likely to be resistance. Point is, big week for energy. Did it change the technical outlook a lot? Not a whole lot. Here's the energy sector on a 60-minute chart. You can see just very bearish action once it broke below the support. These are little bear flags, and they are telling you that price is going to keep going down. Then we got this bigger one. I said to my members, I'm not sure. I don't think this is a bear flag. This rally off of it was a little bit too sharp, but dipped below. So this is this week. Notice where we are. We're right back here at this former support level that became resistance. So right now, it's looking more like resistance. That's another factor. So when I say, did these big moves change the technical outlook? Not a lot. And for XLE, by the way, that's about 34.30 is about that level. Financials were second best, so they had a big week, up 8.3%. This is a 200-day moving average, and this is a 50-day in yellow. So you can see here's this week. Pretty good move up for that sector. This is the last time we saw a similar kind of rotation to cyclical to value, which includes basically financials, the banks. Here's another one of those triangles. Again, it's financials, 60-minute chart. So the technical outlook here did change. It did improve because we got a breakout above that level. So that was one that did see some technical improvement. The banks did really well, up 11.5%. So they led they led the financial sector. That is because yields skyrocketed with the vaccine news and the yield curve steepened a lot. This was a level for KBW Bank Index that had been resistance, really reliable, around 81. So yes, a breakout above that. But again, look where we are. That same level where we saw the last really strong rotation. And I got to tell you, this was a really strong couple of weeks. I was really impressed when I saw it. And then it turned real fast. A little technical improvement, but we're still right back there at the levels we were at in early June. Now, the technology sector. So it was down only 0.3%. So it's not a lot, but compare that to energy up 17%. So massive, massive underperformance. It was the worst performing sector on the week. Remember those triangles I was talking about in the S&P right below its broadening formation? If we zoom in a little bit closer here, what you'll see is the tech sector opened the week above it and fell right back down below it and then met resistance there at this triangle. And this is a 60-minute chart of the same sector, technology. Remember what I was talking about earlier on with the channel buster? Initially a breakout, a little bull flag here, looked really strong, and then just kept pulling back. And the more it does this, if you retrace the entire breakout, that's not a bull flag anymore. That's a complete retracement. Here's the channel buster. Fell down below the channel, boom, zooms right back above. Now here we come into this week. Let me zoom forward. And let me go on like a 15-minute chart. There's Monday. This is an impulsive sell-off into Tuesday. Okay, again, I think market started questioning what's going to happen with stimulus, and this is a bear flag in the tech sector. Quite a contrast to everything else that we just looked at. A very bearish tone. So if this flag breaks, it's got a measured move of about 4.4% down on the moderate side and up to about 6%, a little bit more liberal. Let me show you one thing real quick that just summarizes this idea I'm trying to get across. The disparity in the market. You can see it with the bear flag here. Let's take a look at NASDAQ real quick. It's going to look a lot like tech sector because it's basically tech. You have the same thing, right? Kind of a bear flag. There's that 11,900 level that's been a little bit pesky. Not a huge deal. 12,000 is probably a little bit more of a resistance area to be aware of. But just keep an eye on the price pattern. You have a kind of bearish flag here. Now compare that to small caps. Now, I wouldn't call this quite a bull flag, but it could be a bull flag. Price just kind of comes down. It doesn't retrace all of it. Maybe starting to break out here towards the end of the week. That is a very, very different looking chart than the NASDAQ with a bear flag. So what I've been doing is being very, very careful about market directional trades because I know from this past week, if small caps are up, NASDAQ is likely to be down the same day or vice versa. So what I've been doing pretty much is looking at really quick trades. I've been throwing out ideas for subscribers, for my members. And if you follow me on Twitter, you can check out these charts if you want. This was Thursday, and this was after the market closed. So this is something I was showing my members earlier in the day. And this goes to that theme of kind of really quick trades, kind of in and out. And if you're going to be directional, be in the right place. So what I was saying was the 3C did a really good job at catching a change in character in NASDAQ this morning. Let's take a look at that chart. And this is NASDAQ 100 futures. And here's that morning I was talking about. Prices are rallying. Look what 3C is doing. It's negatively diverging. So I sent out a note to my subscribers that I think it's going to, the NASDAQ's going to pull back to the bottom of the flag for QQQ. That was about 2 points. I didn't take the trade just because, 2 points wasn't too exciting to me. And if we look at the NASDAQ 100 chart, this is exactly where that negative divergence formed, right at the top of this bear flag. And my call was that we were going to see prices move down to the bottom of the bear flag, and that's exactly what happened for QQQ. That was about 2 points you could have made real quick, basically in and out that same day. But again, the point I'm trying to get across is if you are going to take directional trades, first of all, I feel right now that it's better to be kind of like in and out. I prefer getting into the trade towards the close and then getting out the next day, the next morning or afternoon, depending on how things go. But if you're going to take directional trades, you have to have an edge. So 3C gave us that edge, negatively diverging here, showing us that as prices were rallying, people were selling into that at that resistance. I posted another one Thursday afternoon near the close. Thursday was an ugly day for the market, so I'll show you that from the website. Okay, so what you're looking at is the members website. This is Thursday, the 12th. And this is the afternoon update. It's one of the last posts I do during the cash market. Then I have one after the daily wrap. So what we're looking at is the intraday charts of the different averages. So we can see negative divergence in the diamonds, the Dow ETF over here. But towards the close over here, a little positive divergence in 3C. You can see it there. Come down a little bit. Here's NASDAQ or QQQ. Negative divergence in the morning. Price declines. And then we get a positive divergence at session lows over here. So these are things that I was saying, it looks like, we're seeing some buyers trickle in here towards the close. And then here's SPY, which was just more in line. It really didn't offer that much of an edge. And then we can come down and look at VXX. VXX was confirming really strong, but towards the afternoon you can see a little bit of selling here into the close. So this confirms, to me, a little negative divergence in VXX confirms these positive divergences in the averages. And then wouldn't you know it, on Friday, the market rallied off this low. Guess which one was the best performing index? It was IWM small caps up 2.1%. NASDAQ was up, but it was up just shy of 1%. And this is another thing I've noticed is most of the market gains are coming in the overnight session. So basically all the gains on this week were before Monday's open, and then the market just gave back from there. And one other thing you'll notice, you probably noticed it already on these charts, is there's very, very technical trade. You could see on that NASDAQ, it kind of turned over right at the top of the flag, and then it found support right at the bottom of the flag right here, in fact, right there. So very technical trade. I'll show you another example of that. And this is the NASDAQ 100. Here is Monday open sell-off right into Tuesday. Look where it found support, right here at the yellow 50-day simple moving average. And this is that kind of bounce off that looks like a bear flag on the intraday charts. Point, again, is very, very technical trade. So be aware of where resistance levels are, where support levels are, where moving averages are. Now I'm going to take a little bit of a right turn. So gold and silver both fell on the week, down about between 3 or 4%. But Bitcoin, which we've been long through GBTC, the Grayscale Bitcoin Trust, was up 2.4%, and it's had excellent, excellent price action. So here's a 60-minute chart of GBTC, the Grayscale Bitcoin Trust. Big, big bullish consolidation over here. Once it breaks out, look at this, bull flag, symmetrical triangle. Now, I had a measured move target expectation for this leg, actually coming out of this flag here, of 1775. I said, it doesn't mean it can't go higher, but that is the most likely area where we'll see another consolidation. Before this consolidation started, GBTC hit that target. Actually, it fell short by 6 cents, or to put that in perspective, 36 basis points on a 2,000 basis point move, okay? So on a 20% move up, it fell 0.36% short of that measured move target. So again, very technical trade if you know what these patterns are telling you, these bullish patterns. And again, we have another bullish little ascending triangle over here. Let's step back and take a little bit bigger picture view. Okay, so here's GBTC on a weekly chart. It's not exactly the same as Bitcoin, doesn't track exactly the same, but close enough. So this is that melt up into 2017 where, companies that made iced tea started changing their name to blockchain and all that crazy stuff is going on. So it's been a couple of years of consolidation. We're just breaking out now. Here's that last little consolidation I showed you and the breakout from it. But look, first we're above the triangle. We're breaking out of this consolidation. It looks like the consolidation phase of this major run up is done. And here's our previous high trading right, well, actually just a little bit above it. So technically speaking, from price action, it looks great. Not only on the intraday charts like I showed you over here, but this big, big picture over multiple years. So you get a massive run like this and a blow off top and all this speculative frenzy, it's going to take some time to unwind that, to consolidate those gains, get buyers back in, and that's kind of where we are. So I love the look of this chart. It looks like gold did, a year ago, or TLT a year ago. Excellent price action. Have no reason to close this trade. It's a longer term trade for me, so I intend to stay long for a while. So let me see if I can wrap this up a little bit. First, the week was really, really about a rotation back to growth-sensitive cyclicals, value stocks, which means they've been beaten up, they haven't done well, like the energy sector you saw, and kind of out of the stocks that have been popular for the last decade, like the mega caps, the FANGs, Facebook, Apple, Amazon, Google, Microsoft, all those. So one is coming at the expense of the other. It's really odd. Usually, if the market's up, all the averages are up. Maybe one outperforms and one underperforms, but Right now we're seeing NASDAQ and IWM or small caps go in the opposite direction. I think at this point the election is less and less of an issue, except for the Senate runoff elections in Georgia. The COVID cases, I think, were a major issue. I think that's what USDJPY, when it was leading lower coming into this past week, I think that's what it was picking up on, these record COVID cases. The vaccine is what changed that for USDJPY. If we look at it, we have these bear flags. This is what it looked like coming into this past week. This is on the vaccination. So when I said to my members the previous week, I said, I think the reason we're getting this risk-off signal is because of these increases in COVID cases to record levels. As soon as that vaccine news came out, look, retraced it all. To me, that confirms that this is what USDJPY or the currency traders were looking at. And they're a lot less fickle, really kind of, I hate to say it, but a lot less stupid than stock traders. And again, huge disparity between small caps and mega caps. So IWM, this could very well be a bull flag going into next week. NASDAQ, this is a bear flag. I mean, how different can you get between two major market averages on the same week? And really, if you look at S&P futures, it doesn't show up as well on the S&P 500 in the cash market, but at the futures, you see this sharp decline and a bearish flag here, a little break below it and a back test of it. So again, kind of a little bit more of a bearish look to that. And recall, it did retrace all of the vaccine gains by like Monday, Tuesday. Now, while small caps massively outperformed on the week, they did not show any 3C confirmation from the point that the cash market opened on Monday. And that's where we started to see losses. So here's IWM's 3C chart. Here is that low. This is where USDJPY was leading the market higher. 3C is confirming, as you can see, with price over here. They're both moving up until we get into this week. So look at this huge move. All of the gains were before the market opened on Monday morning. Okay, and then we have just no confirmation. That's a negative divergence. It's kind of trending down with price a little bit here, so I'm not like too crazy about like, small caps, IWM is going to fall apart. But the point is, seeing no active buyers in the cash session, sorry about that, through the whole week. In my opinion, that leaves small caps very, very exposed. And if small caps were to do something like this and 3C were to do something like that, I think I would be a seller of small caps, because that would be telling me that the professionals are selling into a rally. Presently, this tells me that the professionals didn't want to chase this gap up. Retail did that over here, and they got crushed. Up almost 9% Monday morning. So retail that was chasing that just got crushed. I mean, look how much it gave back. I think this was one of the biggest intraday givebacks in months. As far as trading, I talked about, I prefer to kind of buy in the afternoon if I'm going to go long and then hold until the next morning or so. And that is because we see this trend that has not stopped since May, where basically all of the gains are in after hours rather than the cash session. So here's a chart that depicts that. S&P 500 absolute performance since the start of May. Overnight session, some 650 points. During the day session, going nowhere. It's a lot easier to move the market in the thin, illiquid overnight session. So take from that what you will. And once again, on the week, S&P 500 up, but closing with the doji star, meaning loss of momentum, and happening right there at the top of this broadening formation. One interesting thing was I looked at yields on the week, and the 10-year yield was up 7 basis points. Yields go up with, economic expectations on this, vaccine news. So it was up 7 basis points, but the 30-year was only up 5 basis points. That's curve flattening. Now, members, I posted about this a lot, especially like in the overnight session, that the long bond was seeing buyers. So here's Treasury futures, 30-year, the long bond, right? This is election night. So basically, we were seeing buyers show up around that area. Okay, and look how we ended the week with a rally in the long bond and what almost looks like a little either bull flag or like a little bull pennant. That is not a good thing for stocks or for the cyclical trade going into next week. So if I just kind of make it simple, higher yields are more likely, bonds lower, yields higher, are more likely to help small caps, to help the cyclical sectors, to help the value trade. So that means, materials, energy, financials, banks. Yields going down is more likely to help the NASDAQ and the mega caps. But one of the reasons that I mentioned this was because a long bond is a safe haven asset. The Japanese yen is a safe haven asset. And we saw something earlier in the week. And what this is USD JPY in the candlesticks and a proxy for the 30-year yield here in purple. This is the vaccine news. So yields shoot up, USD JPY shoots up. But look how yields start to lead lower. Safe haven asset, okay? Buying in the long bond, and that starts to pull USD JPY down towards the end of the week. So if we look at USD JPY, here's the vaccine news. Here is basically a bullish consolidation, and here it is dripping lower as yields are dripping lower. This is basically the exact same consolidation that we saw in S&P futures. There it is right there. And prices dripped lower below and kind of back tested back into it Friday. Yields kept moving lower as bonds kept moving higher into Friday. And USD JPY closed pretty much at the low of the week, other than what happened here Monday. So I'm not saying it's risk off, but it's a little bit more risk averse than I would have expected. Remember that USD JPY is great for risk sentiment, leading risk sentiment, but the dollar is the key still. And I've been talking about this since August. When it started to look like the dollar, but by the way, this is dollar on a 2-hour chart, dollar index, when it started to look like it was finding some support. I think this might be a cup, right? And then a handle over here, which is actually a bullish price pattern. We've seen a couple, breakout attempts and they failed. So this is a very frustrating thing if you're trading the dollar. But the gist is, if the dollar goes up, more than likely, I can say like probably 85% probability the market's going down. If the dollar goes down more, then the market's going up. So this is a really key correlation to be aware of. What is something that could send the dollar higher? Well, if fiscal stimulus isn't as big as it was expected to be because there wasn't a Democratic blue wave sweep, that could send the dollar higher, because part of the reason the dollar's been lower is expectations that they're going to print all kinds of money for fiscal stimulus or monetary from the Fed. And to that point, here's a tweet from me on Tuesday morning, because I was expecting this, and there it is. News that U.S. Senate Majority Leader McConnell, I see no need for a multi-trillion-dollar coronavirus relief bill. And just to put some context to that, here's S&P futures in red and green candles, and I've inverted the U.S. dollar index here in purple. So remember that tweet Tuesday? Look, dollar starts leading lower. The very next day, it leads the S&P 500 lower. So it's key. I'm not convinced the market's ready to give up the ghost to the downside yet. There are a couple things I was just pointing out with the long bond kind of rallying into the end of the week, yields kind of going lower, USD JPY kind of drooping. But if we kind of keep this interpretation of a bear flag, and it kind of got a little rough here when it kind of broke down and back tested. It's not a perfect bear flag. But if we keep that interpretation, I have about a 2.4% measured move from a break of the flag. So from somewhere over here. If that breaks down, I would expect a 2.4% move lower. NASDAQ, on the other hand, in my view, has about a 4.4% measured move lower on a break of this flag. And that's really conservative. If I were to go a little bit more liberal, I would say about as much as 6%. So if I were to take I actually am short the S&P 500 a little bit from the prior week. But based on that, if I were just looking at that alone and I were to consider another short, I would probably lean towards NASDAQ because there's more potential reward. But it really depends on the market signals that we get. So that's a mouthful. And I'm going to wrap it up with that. If you enjoyed the video, please give it a thumbs up. Don't forget to subscribe. I think there's a subscribe link down here in the lower right-hand corner. And also, if you look down a little bit by the subscribe, it will say you're subscribed. There's like a little alarm bell. Make sure you click on that to notify you of new videos, because I not only put out new videos, but I put out several free posts this past week. and I put them on YouTube, so you'll get notifications of those too. Or you can go to the website and you can sign up to get the free posts when they come out, or you can check out being a member and sign up for that. So please give the video a thumbs up if you like it, subscribe, turn on the reminders, check out the website, and don't forget to follow me on Twitter, and I'll leave the links in the video description. Hope you enjoyed it.